Let's bring in Aswath Damodaran from the NYU Stern School of Business. Great to see you, as always. I don't know where to start on this, but I think the first point to note is that it's fair to say a lot of those smaller mid-cap tech stocks that appear in Woods' portfolio have fallen a great deal already and are certainly a lot cheaper than they were last February.
Yeah, that's a fact. And the reason for that is very simple. These were momentum plays and momentum shifted against them. That said, though, it sounds a little delusional to be talking about bubbles when your biggest holdings are Tesla and Square and Teladoc. And I mean, if you're talking about bubbles in value stocks, then you better be talking about bubbles even at the reduced prices at which you're holding these tech companies. So I think that, if you're going to make an argument that you want to stay in tech stocks, it's got to be a little bit better thought through than just pointing to the rest of the market and saying, hey, that looks like a bubble to me.
Do you think some of those value stocks, though, are also looking expensive? I mean, it's interesting what's happened to bank stocks this year. They ran up for a couple of weeks and, despite decent earnings, have pulled back a lot.
Now, if you look at, if you define value stocks as looking across low PE ratio companies, 2021 was actually a very mixed year. Financials had a very good year, but consumer staples and utilities didn't do that well. So I think we might need to start using categories that don't fit into the old-time value and growth, because I think you're seeing the market differentiate across different groups of value stocks. So I think that if you want to make the argument that financials are overvalued, then I'm willing to listen. But if financials are overvalued, the market is overvalued as well. Because what's carrying the market up is this low expected return environment built off low risk-free rates. And if that changes, then I think you're going to get a lot of repricing across the board, and it's going to hit both value stocks, growth stocks, tech stocks, financial. Nobody's going to be safe in this carnage.
So what's a fair price? I mean, how much damage do you expect, say, for the NASDAQ composite, which does have a lot of these sort of momentum names, as you call them, but also the mega cap FANG names, which often act defensive. It's basically correction mode for the NASDAQ right now, 10% off the highs. What sort of level is appropriate given the interest rate outlook we're looking at from the Fed?
No, I'd say if rates are going to rise to 2.5% to 3%, you have at least another 5 to 10% correction in the overall market, and perhaps a bigger correction with tech companies, because I think when all of your value lies way out in the future, I don't care what they look like now, but the value that you will attach, 2 weeks or 4 weeks from now, when risk-free rates are 2.5% or 3%, is going to be a lot lower. So I think it's going to be damage across the board, but it's going to be greater for growth companies. If they happen to be tech companies, and I think you're going to see the damage being greatest there.